Hello guys, so today I'll be reviewing another trade breakdown on Euro NZ. Took a sell position today in the morning which hit my target very fast, risking about 45 pips for 135, which gave me a reward of 3. I shared the analysis on my Telegram channel last week when the market was just about here on Monday, and my prediction was that in case price was to touch this supply zone, then I'll be looking for a bearish setup. So all the way from last week Monday, the setup played out today on Monday, which is just about 1 week later. Where I took the trade, I had marked my supply zone all the way back from about 27th April, which is just about 2.5 to 3 months ago. And if I can go back to 26th April to show you how I marked the supply zone. So as you can see, price was previously forming higher highs and higher lows, meaning it was inevitably in an uptrend. Then what happened is that at a certain point, price came and traded below this higher low. That means it violated the structure, and that break of structure from this previous low suggests a possibility of a bearish reversal. Since this move has broken the structure, it will no longer be a retracement, but I'll consider it a bearish impulse. So once we've identified this as an impulse, the beginning of that impulse is what we will call our supply zone. And I mark my zone from the highest point to the first red bearish momentum candlestick. Now I do have a rule whereby my zone cannot surpass 50 pips. It's just one of the measures that I use to make sure I limit the number of trades that I'm taking to only the highest probability setups. So since this zone was more than 50, I come and measure the 50 mark level, and then I put a horizontal line and I readjust my zone to make sure it doesn't surpass 50. Now this only applies in the case that the zone is more than 50, but if it is less, I just use it the way it is. So now my supply zone has already been marked, and in future when price comes back to this zone, we'll be looking for a bearish setup. Why this zone is important is because anytime we have that consistent push in price, either below or upwards, we say that the institutions are the ones influencing the push of price in the market. So if the institutions are the ones pushing price lower, we want to find their point of origin. Where is the first point of interest where they started reversing price to the downside? And that's why we mark it as our supply zone. So in future, whenever price will go back to that zone, if I can zoom out and you can see, price traded back to this zone just, I think, last week on Friday, but I got the setup today on Monday. The reason why I anticipate price to drop at this level is because it's where the previous drop in price started. So we are expecting a possibility that price can do the same thing. Remember, technical analysis is all based on the analogy that history tends to repeat itself. So if you test out supply zones, you realize most of the time price will have a bearish reaction at this zone. Another way to look at it is that the supply zone lies at a previous high. Now what happens is that if you check currently, price has been moving from this low to that high. This means a lot of buyers have been pushing price up. Now as the buyers push the price from this low to that high, there is a high chance they'll be looking to liquidate their positions at a previous supply level. That means when price touches this level, you can expect a possible retracement or a possible bearish reversal, because the market has been moving up for a long time, and since this is a key level, the buyers will want to liquidate their positions. So they'll sell off their positions to get the money. And when they close their buy trades, meaning they're selling them off, there's a high chance we'll see the market dropping. Now, sometimes the market can drop and it ends up being a complete bearish reversal, or it could just be a small retracement like this, then you see the market continue going up. Whatever happens, my strategy focuses on taking advantage of this bearish reaction. So whether the market will eventually continue dropping to the downside is not something I try to predict. Whether it will only be a retracement and it continues going up is also something I don't try to predict. But the data from my backtest tells me there is a high chance of the market reacting with about 130, 150 pips. That's all I'm trying to capitalize on. So anyway, the market came back to the zone last week on Friday, and now I'm anticipating a possibility of an M pattern. If I find a complete M pattern, I wait for price to retest the neckline and I'll be going short. Coming to this week on Monday, the market had just completed my first M pattern today in the morning by about 7 a.m. So we had this push up red candlestick, then this green candlestick simply means when you see this wick, it means the market traded to that top, then it came and closed all the way below. So the most important thing for us is that the neckline should be in the middle between the opening candlestick of the pattern and the closing candlestick. So the first candlestick that closes below this neckline is what completes our M pattern. And now I wait for price to come and to test somewhere at that level. That is where I'll be looking to go short. Part of my rules is that it's not all the time the market will come at the neckline. So I always give my trader about a 3 or 4 pip spread allowance, just in case the market doesn't trade to the neckline. So because of my spread allowance, I ended up putting my sell limit somewhere at that level. Then I set my order, and now I was waiting for the market to come and trigger. So the trigger happened, I think, with the next candlestick here. So the next candlestick came and triggered my order, and this is where my trade was running. So my stop loss was already set at 45 pips, my take profit at 135 pips. And for me, whenever a trader has moved at least 50 pips to my target, I always set my stop loss at break even. So whenever my trade is running, the first thing I do is that I come and mark the 50 pip level. And it just helps me to anticipate and know the exact time to put my stop loss at break even to make sure my trade is running risk-free. So my sell limit was triggered at about 8 AM. The 9 AM candlestick didn't do much. Then at exactly 10 AM, we found one long candlestick, which of course was catalyzed by the news. We had some news on the euro today at about 10:30 in the morning, and the news came out extremely negative. And this is a perfect example of how I just use my technical analysis, but I let the fundamentals act as a catalyst. So I don't really focus on fundamentals, trying to predict if the news will come out positive or negative and waiting for the news to react to the markets. Instead, I do pure technical. So by the time I was getting my trade, this was at about 7 or 8 AM. The news came out over 1 or 2 hours later. So the news already found me in the trade. I didn't take the trade based on the news. So in the case that news comes out against me, I just let my trade run based on the technical analysis. If it goes to stop loss, well and good. If it goes to break even, I have no problem with that. But again, I've already back tested and I've proven from my data that whether I trade during news or not, my technical analysis is way more valid. That's how I got the trade. The interesting bit is I marked my supply from about 27th April. We got the trade today, which is just about 3 months. And if you understand my strategy, as long as a zone has never been broken, then it can be used even in future. So if you check from marking the zone, price never attacked this zone anywhere from that date. So it's taken about 3 months to come to a very, very old supply zone. As long as the zone is still valid, we take the trade and the result. And that's it for this video breakdown. Be sure to like the video and subscribe for more trading content.